On set, we have Sam Chester of Clarity Capital to give us insights on the Chinese stock market. Well, thank you very mubut for being with us today. What is the cause of this major slump we've seen in the Chinese market and now this rebound today?
Well, what's interesting is that the cause of the all but collapse of the Chinese stock market over the last month, the roots of the crash really lie in the rally over the last year. The Chinese stock market has been one of the strongest stock markets in the world since about mid-2014. The roots of that lie in part because China's real estate sector was coming apart in 2014. People were looking for other areas to put their money. Many people started investing on borrowed funds into the Chinese stock market. This borrowed financing is really what led the rally to grow so high. And what that led to was a classic bubble effect, because as people looking at China understand, the Chinese economy as a whole is not doing very well. Growth is falling, imports are falling, and therefore there was this classic incongruence between an economy that is not doing well and a stock market that is doing so well. Eventually, that led to a speculative bubble that investors grew very wary of and then fled. And that's really what has been this crash that we've seen happening over the last 4 weeks.
So in a sense, this market might be stabilizing, but what efforts are the Chinese now, the government, doing to prop it up? And is it really in their favor?
So the Chinese government has had a very central role. Some observers have noticed that the Chinese government has actually put more money, we're talking about tens of billions of dollars, into sort of responding to this crash than the U.S. government did in 2009. So we're talking about untold billions of dollars in just 2 weeks.
So this is
that they've been pouring in.
massive stimulus here that we're talking about.
A massive stimulus is going into effect. What's interesting is that the government's has been trying since January, actually, to roll back the role of leveraged financing, of borrowing money and putting that into the stock market that they're seeing in their stock market. They were trying to regulate and not allow people to put borrowed money into the stock market. Their attempts to do so is actually what spurred the crash to start in June. So since then, they've actually changed tax, and now you see the Beijing government allowing more borrowed money to go in, but even more so, you're seeing them do things which you would never see in a Western government. You're seeing them essentially tell their pension funds and tell private companies, put money into the stock market, keep it going in a way that they hope will then ensure that there'll be no rebound effect on the broader Chinese economy.
Well, do you think that this situation is going to get worse?
Generally, the sense is yes. I mean, the main reason why we tend to think that the Chinese stock market is going to get worse before it gets better is, despite the slight rebound in the last few days, you're talking about a classic market that was overvalued. As we said, it was a classic bubble effect. The fundamentals, the Chinese economy was not doing very well for many, many months now, and therefore the speculative investment into the market could only sustain itself so long. So that is expected, therefore, to decline as it sort of comes into alignment with the fundamentals. What's key here is that the Chinese stock market, unlike stock markets around the world, is heavily invested by private individuals, not like what you see in the West, where it's mostly large banks and financial institutions. As a result, the people who are going to really take this hit in China are going to be the small-time investors who may have put all their savings that they borrowed money to do so into the stock market, and now they're going to lose that in one fell swoop.
Do you have any sense about who those investors are? Are they mostly in China, or do we have some of these private investors all over the world here that are really going to take a hit?
So what's coming from your question also is that why is this so important to global observers? And the reason is that this is really the major economic story of the last few weeks, much more so than what's happening in Greece. It's what's happening in China. I mean, the Chinese stock market has lost 6 times the value of the entire Greek economy just in the course of several weeks. So it potentially has tremendous impact on global investors. In some sense, it's very limited just because Chinese rules do not allow global investors to really be involved in their market. So global investors really only invest in the Chinese stock market at about 2%, and yet the rebound effect on the broader Chinese economy would have a tremendous rebound effect on the global economy as a whole.
Indeed. I mean, being the second largest economy and also set to surpass the U.S. as the first, certainly definitely impacts the world markets and the global economy. Thank you very much for your insight. We do appreciate it here as always.
It's a pleasure.